Multifamily is finally turning a corner. Pricing is projected to increase with current lower interest rate environment, and new construction is slowing down while more and more people are still being pushed into renting. Now, that combination doesn't happen often, and when it does, smart investors pay attention. Now, the challenge is many people are still worried because of the headlines that are maybe talking about things like too much supply or insurance is crazy and interest rates are high. But if you only look backwards, you miss the moment of opportunity when it does show up. So, in
Mhm.
this episode, we're going to break down in a simple, clear way a few things: why right now matters, what's actually happening with supply, demand, and debt, how we're evaluating deals in today's market, and practical steps that beginners and experienced investors can take today. If you've been curious about multifamily or wondering whether this is a good time to invest, this episode will make everything click. So, you don't want to miss it. Mark, so good to be here today. How are you doing?
John, yeah, great job with the intro. I think that this is like a very, very exciting topic that we're going to be going over today because when you are at a bottom in any market, it doesn't feel like you're at the bottom at the market. So looking back on it, I've been in real estate for close to 20 years now, and looking back at all the down cycles that we went through, we're in the
Mm,
down cycle. I don't recall any sort of moment where somebody's like, okay, we're now starting to hit the bottom. Like let's like really reflect that. Where's the opportunity today? I don't recall that. What I do recall is that in those markets, in those times when I went back and reflected, I do remember them just not being a really, we'll call it a sexy environment to buy real estate. It was like everything was negative. The newspapers were saying it's at an all-time low, it's never going to recover. Like all friends and family, anything to do with real estate were not, we'll say, positive. I do remember that. And so this episode, we're going to be diving into why we think that we're starting to hit a bottom. And this is like it's a phenomenal opportunity to be
yeah.
buying in today's market. Now, if you do want to learn more, go to fulloutinvesting.com. And by going there, you'll see a video broken down as to our 10-step full out investing system. And then there's a way that you can go on and actually book a one-on-one call with either John or myself. So go to fulloutinvesting.com to find a little bit more about what it would be like to partner and invest with us. So yeah, John. So this talk's going to be diving into some more details on that, and so I think that if somebody really listens to this conversation that we're about to have, and then takes action on it, I really believe 3 years down the road, 3 to 5 years, even sooner than that, you're going to be looking back in today and be like, wow, I'm sure I'm glad that I listened to that podcast and took action.
Yeah. Mark, it's interesting because I was, just read this really fascinating book called The Psychology of Money. And, it was actually talking more specifically just about investing in general and just, the human relationship with money and how it's evolved over the years. I won't get into the weeds on it, but a very fascinating read. But one of the data points that jumped out, now this is talking about, once again, sort of like if, say, for example, you're investing in an S&P 500 index fund. And let's just say you perceive that the market might go down and you sell, right? And you want to time the market and you want to kind of time that upswing. If you miss the 10 best days of that upswing over a 35-year period, your returns would be cut in half. And so the idea is you really can't time the market perfectly, but what you can do is you could read the signs that are happening in the market. And so it's interesting right now because we're seeing this market where interest rates are still high, although they have come down a little bit. Insurance is still a tad higher than it was, although we are seeing some massive savings. I think about Largo as a prime example where our original insurance quote on a per unit annual basis was $1,850, and on renewal it's down to $950, right?
Mm.
So you can't underwrite that. You have to assume that what you're getting is what you'll continue to get. But that's just a great example of how the market is adjusting so quickly. And so, in terms of timing, at least for us, let's talk about the case for now. Like, and it's just data, right? Like, what is the data case for right now? Well, in the supply and demand world right now, we're seeing in Q2 2025, we absorbed 116,000 units across the United States. Now, that's one of the strongest quarters since the year 2000. So, one of the best quarters in 25 years. And vacancy is continuing to improve on a quarter by quarter basis. Another big factor is there was a huge supply wave that came based on what was happening in 2018, 19, and 20. We had very low interest rates. We were still sort of, long out of the Great Recession, but there was still a little bit of pain that people were feeling. So a lot of those buildings started getting developed, and we saw a huge supply wave. Well, as of where we sit right now, there are only 500,000 units across the United States under construction, and that is the lowest it's been since 2016. So, with that supply now moderating and flattening out, we're also seeing demand increase, which I just mentioned, right? So, this is a couple of great signs. And then let's just looking at occupancy and rent stabilization. So, because of all this supply, in some markets, we were seeing negative rent growth, but now we're seeing national annual rent growth at 1.7%. So, all this just creates a healthy backdrop for why value add real estate investing is a prime opportunity today.
Yeah, and if you just, break it down into like really simple terms, is that real estate goes through these we'll say these swings in these markets. You have up markets, you have down markets. There's real estate cycles. We study them. Generally it's between like 12 to 20 years is where you have these real estate cycles. And so what happened at the peak of the market, 2021, we'll say 2020 to 2021, and then it peaked in 2022 at the beginning of that year. It was like at that point, real estate was so sexy, right? And
Yeah.
so you had a lots of, we'll say everybody and their sister was buying a real estate, right? And their
Yeah.
brother. It
Yeah.
was like their whole family. Everybody was buying real estate, and everybody was encouraging, saying, "Yeah, it's amazing." The newspapers, everything was amazing. And so developers saw that demand. And they're like, "Geez, like we got a lot of buyers here. Let's build."
That's
Let's
right.
go and buy land and build. And so they did. And so what happens in a market like that where everything is growing very quickly, you have all these developers that are like, okay, I'm going to get my project up and going, and they sell out and they sell it to their investors. And then what happens is, okay, they start to get, boots on the ground. They start to dig, and they go through all the permitting process and whatnot. Well, when that happened, by the time everything was starting to get built and then started to get delivered, what happened is when the market started to turn, those buildings are still they need to get built. And
Yeah.
and so
Yeah.
what's been happening since the peak of the market, there's been more and more supply that started either at the peak or just before the peak, and they're getting built and they're getting delivered into the market. And so what happens there is that as more and more inventory comes onto the open market and the amount of demand starts to shrink or starts to subside, what happens is rents come down.
Yeah.
And so with that, that's been happening the last like 2 to 3 years. And so now what's happening is the stuff that was at the peak of the market, the inventory, the new builds, those are now getting absorbed into the open market. So they're getting delivered, and there hasn't been a lot of new development over the last like 2 to 3 years since the peak of the market. So what happened where we're at right now, we've seen rents come down, and then we've seen price per unit come down as well. In some markets, like 20 to 30% from the peak of the market. And so with all these getting delivered in the market now, we track, okay, where's the market going forward in 26, 27, 28? And all projections are showing very strong rent growth and increase per unit, price per unit. And the main reason for that is that there hasn't been a lot of these new builds over the last 2 3 years. So we have ongoing population growth, especially in the markets like Atlanta, Charleston, Tampa, these markets that are high growth areas. There's still population moving in for affordability, employment, low taxes. So they're moving in, and they're moving in for affordability. And so there's ongoing population growth and demand there, but there's been very little new supply being now delivered. So 26, 27, 28, that's the main reason why we're starting to see a swing back into a more of a growth market at this point. And it's a really, really exciting because we can see the data, as you mentioned, John. And now it's just a matter of time of everything playing out. So this is where, like, I'm screaming from the rooftop to as many people that I know. It's like, now is the time to be buying real estate. Anytime in my last 20 years that it hasn't been sexy to buy real estate, when most people don't like it, that's the time we should start looking at the data and saying, yes, now is the time that I want to be jumping in and locking in my price and to have very strong gains moving forward.
That's right. Yeah. And it's showing up, right? And so, for an investor that's maybe newer to this, that's basically how a building is valued, right? So it's the income approach. So what is the net operating income and what are the prevailing cap rates in that area, that capitalization rate? And so this is not across asset classes. This is just in multifamily. Office is still challenged. We're seeing challenge, although there's pockets of prosperity for retail in certain areas. But for example, we're also thinking about, what if we go into a recession, an economic recession in the next year or two. So I'm bringing that up because things like car washes and storage have been somewhat sexy over the last few years. But if there's a recession and somebody's income comes down, perhaps they'll cut that car wash subscription, or maybe they'll make some room in their garage for their storage and get rid of that storage unit. But because of, once again, and this is the crazy thing, Mark. So I mentioned a stat on this podcast a few times that in the United States, the average first time home buyer 4 years ago was 28. Last year, it's 38. This year, it's over 40.
It's
So the
crazy.
average person just cannot afford to buy a home. And we are going to become a nation of renters. We're already heading down that path. Now, there is also a trend where some younger people are just choosing to rent. They like the flexibility renting provides. And so if they decide they want to up and move to a new city and find a new job, they can do that. But we're seeing cap rate compression. And when cap rates go down, values of buildings go up. And so cap rates are falling ahead of our other commercial real estate peers and other asset classes. So that's a great sign. And in fact, if you look at sort of like new Class A buildings, they're trading at like 4.75%. We have not seen that since prior to 2020. So a lot of great things. Now we buy value or Class B and sometimes Class C that we can get to a Class B. But the point is we're seeing some really great cap rate compression, which is a sign that the capital markets are waking up and getting back in the game. We're also seeing debt, right? The agencies are easing borrowing costs relative to last year. So part of that has been driven by the Federal Reserve in the United States lowering the bank rate. But we've also seen movements in the treasuries. And so the agencies are getting back into the game in an aggressive way and providing just better loan terms. We're also seeing that in some of the other, agencies out there that, offer lending like life insurance companies and insurance companies. Now, we do typically work with the big agencies at Faris Capital, which are Fannie and Freddie. So the capital markets, the big institutional players are getting into this space. And so that's something we watch very closely. When Blackstone and BlackRock and some of the biggest players are betting big on multifamily, that's a clear sign that it's time to pay attention.
Yeah, 100%. And so, with all that being said, it's like we're starting to see a turn. We're seeing the data saying, 26, 27, 28 is gonna be strong, especially in the back half of 26, 27, 28. And so this is like a phenomenal time. And so just to give you some context, we're buying properties. Like we acquired an asset that was like under $100 a square foot. So to give you some context, to replace that, you're anywhere from 300 to $350 a square foot. And so even our latest asset, John, in Noonan, it was
Yeah.
there's three different parts to it. There was mid '80s vintage, and then early '90s and late '90s, and so it was a really good mix between 1 and 3 bedrooms. And that worked out to about $169 a square foot. And so, really, I mean, it was well built and just really nice still. It still had some lift opportunity and rental increases, but uh, $169 a square foot compared to over $300 to replace that. So we're buying assets that are well like half of replacement costs.
Yeah, that's right.
And not only that, they're cash flowing from day one. So, these properties, they're spitting out cash. You're buying below replacement costs, and it has upside both on the operational efficiency side and in the rent lift side as well. So, if you can lock in your pricing with we'll say all the above that I just went over with you as well, man, it becomes like a really exciting time to be able to lock in pricing. But John, it's not for the faint of heart,
Yeah.
right? Because you read the newspapers, it's not going to tell you that. But the data we're
Yeah.
following and the other large operators that are out there, they're quietly they're going in and they're accumulating right now. I just spoke with one group. They have 10,000 units, and so they launched $100 million fund this year,
Yeah.
and so they're acquiring in large sums here. And so this is going to be a time we're going to be looking back, and I believe in 2 3 years from now, and we're like, oh man, I missed it. It's like,
Yeah.
and so that's a big part of why we're doing this podcast here today.
That's right. And so, in terms of, how we're underwriting in today's market, right? We're very sensitive to not overestimating, potential rent increases. So, conservative organic rent lift. You touched on this earlier, but we're targeting assets that have either operational inefficiency, that means that they're not currently even charging market rents, right? So, there's some potential lift there, but also our post renovation rents, right? So, just making sure we're not only looking at, conservative rent growth, but also conservative exit caps, right? Our goal is always to over deliver, bottom line. So we're always going to underwrite conservatively. So even though the tea leaves are sort of suggesting this is a great time to buy, we still want to keep that conservative approach to our underwriting, right? We make sure that we stress test and get firm quotes for our debt and insurance and our property taxes. So working with third party consultants that look at the taxes, working with our insurance broker to get multiple quotes that are basically ready to lock. So we know exactly what those numbers are going to look like prior to submitting an offer. And then we touched on our golden rules, but that idea that we're only taking down fixed rate debt, having strong principal and interest in reserves, as well as a 10% tax capex contingency. So, in other words, our renovation budget, just netting it up 10% just to factor in any potential unexpected costs. So, then it comes down to execution. So we immediately, once we take down the asset, implement our 28-day full out transformation, making an immediate impact, adding value to the property, signaling to the residents that new owners in town, and we're here to improve their lives and honor our mission of going full out for our residents, providing that best living experience in the world, which I will say gives us an edge and why we're often outperforming the market rent growth assumptions, because by providing an exceptional experience, we can outperform the market, right? And so we don't underwrite that because, it's not hard, but what we can do is do those soft things like an incredible resident experience, adding value immediately, and it's showing up in the results on our 6 current deals where we're either at or well ahead of our NOI projections, relative to where we are in the life cycle of the deal.
Yeah, 100%. So this is where the other thing, John, that I'll add in to this is that there is a lot of money sitting on the sidelines currently right now. Still, there's a lot of large groups that are just they're waiting when that comes in. And in some cases they're waiting because they're thinking, okay, you know what, I want a little bit more stability in the marketplace. So what they do is they wait for the market to show like significant, okay, it's definitely coming back, and then they jump in at that point.
Yep.
But at that point they've missed some of that upside by actually getting in a little bit earlier. So when that money comes back in, and a big part is, I know with tariffs and whatnot, like there's still that conversation. It's like, okay, I'd like to kind of see how that's all playing out. But when that money comes back in, there's going to be a lot more demand for these multifamily properties, and you better believe that price per unit is going to go up. It's just simple supply and demand.
That's right.
Um, and so the other thing too that we've seen, John, in this market is really interesting is that sellers are a lot of them are just waiting now. So
Hmm.
they're waiting for pricing to come up. They think interest rates will come down a little bit, and so they're waiting in a lot of cases. So for us, John, as you know, like used to be 1 in 100 to find these deals at something that actually makes sense and pencils out. And then it was 1 in 200. Well, now in this current environment, to get something that we believe is priced in today's market, it's we have to look at 300 different opportunities to find one. So it's interesting. Not only has pricing come down, but the volume, sales volume, has dropped dramatically. And so this is where it's like the deals that you do find, when you do find them, they're that much more valuable in today's market.
That's right. So if you're an investor listening to this, you want to kind of start analyzing what are your goals, right? So, how do you want your dollars to work for you? So is it income first approach? Is it a total return, so that, cash on cash return plus equity growth? Mark, most of our investors, they want their cake and they want to eat it too, right? They want good cash flow, but they also want that, good
I do.
equity
I like
growth on
that
the
too.
upfront.
It's like I
I do
don't think
too.
that's
Yeah.
yeah. I think there's it's very hard to find that though.
Yeah.
Like and so
And
the
that's the
investors,
300 to 1 really,
yeah,
right? And that's why, right? Because one of our rules is we only buy deals that cash flow on day one, right? But, decide the job of, that you want, how your dollars to work for you. And then within Ferris Capital Partners, we actually offer multiple share classes. So we do have an option for those that are really focused on that income, right? And that strong cash on cash return. Every deal is a bit different, but that could look like up to 12%, annual cash on cash return on your dollars. And then we have different share classes. So the more you invest, the better your unit economics. So in other words, when somebody invests, say 250, 500, or 750 with us, we actually give up more of our income in splits to that investor. So you can really choose the class that works best for you. And then really look at kind of what kind of properties are you interested? We love value add because of that opportunity to force appreciation, but maybe ladder some commitments and look to invest in a few projects over the course of the year. In fact, over 40% of our current investors, Mark, as you know, reinvest in multiple deals with us because they like the opportunity to place a little capital, maybe say in Atlanta, a little in Charleston, a little in Florida. We are now looking at other markets like Texas. So in a sense, they can diversify just by choosing some different markets to invest with us, right? So and I think too, as an investor, you want to make sure whether it's with us or anybody else, ask these questions. What kind of sensitivity analysis have you done? What kind of stress testing have you done? What is it about this particular market and submarket that you think makes it very attractive, right? And do we have hard quotes from insurance, debt, and things like that when you're making that decision? So that could just good data or good kind of questions to be thinking about with whomever you're investing with, right? And then kind of on our side, right, that risk mitigation, because even though we believe now is one of the strongest times to invest, we still want to make sure we're protecting as much of the downside risk as possible. So really digging into regional supply pockets. We don't want to buy a Class B building in an area surrounded by beautiful new Class A buildings, right? So we want to find projects that, have close proximity to all the amenities that somebody's looking for, like jobs and entertainment and shopping, but we don't want to be kind of in the middle of, where all the new growth and new development has just hit the market. The reason for that, just for investor knowledge, is that often when buildings are being delivered, they offer exceptional incentives like a month or two of free rent. So you might see a headline rent of $1,800, but the reality is it's really like 14 because they gave away 2 months rent, right? So making sure that when we're looking at our debt, we're also kind of looking at multiple exit pathways, right? Like what happens if this were to happen? Could we support a refinance? And would that get our investors some of their capital back and keep the deal cash flowing? Our goal is typically to exit these deals, to be very candid, but we also want to look at other scenarios just in case those what ifs that you can't always predict do come up. And then we're just really looking at our operating expenses and looking at worst case scenarios for things like taxes and insurance and making sure those are all factored into that sensitivity analysis.
yeah, right on. And just for some further context with that reinvestment, that 40%. So we've closed on 6 assets so far, about 500 units is what we've closed on within the last like 24 months in this market where it's like 1 in 300. So that we had closed that many are it's actually when we speak with other operators out there, it's been it's been successful. Moving forward in 26, we are looking at our goal is for another to add another 500 units is what our goal is. But that 40% reinvestment in another deal, that's if you take the six of those six, we're actively going through the business plan. So we haven't actually exited those yet. So this is where 40% are in more than one, as in they like what's happening with the distributions. We're overshooting our projected rents. All of our Fairs residences deals are overshooting our projections. And so that's where, John, it'll be really exciting to see as we go in and we exit, and then the reinvestment at that point
Yeah,
is going to be, I think it's going to be well ahead of that 40%
that's right.
number. That'll be interesting, and we're getting closer. It's like interesting. You and I were just talking. It's like we have this. There's a number of our assets that are doing really well. It's like, where our projections are 3 to 5 years, but in some cases it's like, well, after 2 years, how does that look,
Yeah,
from an exit, and the mission, as you and I have talked about many times, is we want to not only hit our projections or generally their 20% annual returns, and then we got that 12% preferred share class as well. But not only do we want to hit, but we want to overshoot, right?
Yeah.
And then we'd like to be able to have the option to go into another value add deal that is 1 in 300, so that you can do even better on the next one. So that
That's
is that
right.
is the mission for us moving forward.
That's right. So some signals we're continuing to watch in real time, that quarterly absorption, versus delivery trend, right? So whenever we're looking at a market, we're really drilling down into like a 3 to 5 mile radius around the asset. And we look at the broader market as well, but what's really happening in that direct radius around that building, what new supply. In fact, it's interesting, Mark, but whenever we're, say, for example, touring an asset, if we see a piece of land, we're like finding out what's going on with that, right? Like what's it zoned for, who owns it, are there any things filed with the county or the city, relative to what may come there. And a great example is our Monk's Corner deal, because when we looked at it, we loved it. And then we kind of drove out and we're like, gee, there's a big piece of property with a for sale sign in it. And like, what is that zone for? Right. And we looked into it and we got some good intelligence back. And turns out that the city has now bought that land and it's being turned into a public park. So in effect, it's becoming an amenity for our community that we didn't have to spend a dollar on. But if we went too quick and just bought that deal and turns out it was zoned residential, next thing you know, number one, there's a construction site, disrupting our residents, but a potential future multifamily building that could have really created some challenges. So, we're looking at overhead satellite maps. We're trying to identify any pockets of land and we're digging into what's happening. That's where a lot of operators make mistakes. They drive by the land and they just, well, there's nothing there now, but you need to know what is that zone for and what could happen. We have the same example at Georgetown. There was some land right out front, turns its own retail, and likely will just add another shopping complex for the area nearby at some point in the future. We're also looking at the bid ask spreads, right? So what are sellers marketing these deals for, and what are the offers coming in out now? In a sense, that becomes a little anecdotal, but we track this, right? So we see what the guidance price is on a deal, we underwrite it, we know what we would offer on it, and then we communicate with the broker. And brokers are often very forthcoming and they'll say, yeah, a lot of other operators are giving us similar numbers. So we're watching that spread and we're actually starting to see it compress. So we're starting to see, I guess I would say, sellers that are a bit more realistic about what's happening in the market, where last year, I would just say, to put it politely, a lot of them were in fantasy land, not really reality, right? And so that is starting to shift. So that, and what are the cap rates on real closings that are occurring in the marketplace, right? And so we can study that data through CoStar and through broker conversations. So, kind of putting this all into a sentence, right? Like what's happening in the market right now? Demand is holding, supply is fading, capital costs are improving, and
Mm.
multifamily relative returns are leading the pack compared to other commercial real estate. But that combination won't last forever, right? So now's the time to dive in. And you touched on this earlier, but if you're listening to this and you're intrigued by what we're talking about, go to fulloutinvesting.com. It's a great resource where you can learn a lot about our unique approach to not only finding and acquiring these buildings, but our business plan all the way through exit. And we'd highly encourage you to book in a time to talk. It's not a hard sales pitch. It's just to get to know you so we can learn more about your goals, share with you a little bit more about what you're doing. Mark, a lot of our investors, it's an education process. It takes some time. So we're here to educate and we're here to help.
Well said, John. And thank you, everyone, for listening. If you enjoyed the show, you can go ahead and subscribe and share it with another high net worth investor that you think will benefit from it. Thanks for tuning in to the Full Out Real Estate Investor. We love and believe in you guys. Keep dreaming and investing big.